So I'd like to answer a couple questions today on private equity, being how can your typical high net worth investor, whether it be an accredited investor or a qualified purchaser, access private equity? Why would you want to do that? And then, of course, exactly what is private equity? So I'll kind of start backwards with what is private equity, and it's really quite simple. It's any investment that is not traded on a public exchange. So any company that is not listed, of which there are many and large companies as well, that an investment is made in would be considered private equity. Now, there's different types of private equity, which I can get into more detail on. But historically, access to private equity, those types of investments, has really been out of reach, even for a qualified purchaser, for example, which qualified purchaser is an investor with 5 million or more in investable assets. And typically, private equity was limited to institutional investors. So your pension funds, your endowments, your foundations, and the minimums could be $5 million or $10 million or $20 million. And that has really shifted, especially in the last few years. Even the leaders in the private equity space are now kind of zeroing in on more of the retail investor. Of course, there's still minimum investments and limited liquidity, but even some of the top tier funds are accessible now by either accredited investors or qualified purchasers. And private equity can be an attractive way to diversify a portfolio and achieve a superior long-term return. And actually, I would add something to that: with less volatility than you're going to experience in the public markets. Um, and when you look at the opportunity in private equity, it's quite large when compared to publicly traded equity. So on the right here, this bar graph, the first one to the left on the right side of the page, is companies in the United States that do over $100 million per year in revenues. 87% of those businesses are private companies. Only 13% of them are actually publicly traded. So if you're only accessing publicly traded companies in your portfolio, you're really only getting 13% of the opportunities that are truly available out there. And additionally, typically by the time a business goes public, many private equity firms have bought and sold that company's equity. They've increased EBITDA, they've increased revenues, they've gotten as much profitability and growth out of that company in a period of, could be 5 years, it could be 10 years, could be 20 years, but as possible. And then private equity's exit strategy is sometimes to take the company public. They could do a side merger, an acquisition, or sell it again in the private equity space. But many times, once they've gotten all the growth out of it that they can, they take it public, and then it's available to all investors on the major exchanges. This is an interesting slide, just showing the shift in what's been happening in businesses, in that companies are staying private for longer than they used to. So if we look at Amazon, founded in 1994, went public just a couple years later in 1997, the private market return was 10x, still not a bad return, but the vast majority of growth happened once they were a publicly traded company in the public markets. Let's go over to Alibaba, for example, founded in 99, stayed private for about 15 years. So they did their IPO in 2014. The private market return was 9,316x. The public market return has been 2x. So overwhelming majority of growth happened in the private markets, and Facebook is a fairly similar scenario. But when you look at the number of listed U.S. companies, it's consistently gone down. and the average size and age of a company at their IPO has gone up. So IPOs are getting larger, which means that valuations are increasing more in the private market. There's more growth happening in the private market, therefore leading to a higher valuation when they do go public. And then the number of IPOs is diminishing, meaning more opportunity is staying in the private market. And interestingly, private equity does consistently outperform the public markets, and I will show you that in just a moment. But first, when specifically does it outperform? And interestingly, this is showing the x-axis here, the public market return. So let's say we have a public market return in a year greater than 15%. Well, private equity as a whole does outperform, but only by about 1.5 points. But when we see your more typical returns in the public markets, let's say 5 to 10%, that margin gets much wider, and private equity outperforms by almost 8%. And even more important, when the public market is down, let's say more than 5%, again, we see that margin of outperformance of about 8%. And we are now in the first 2 months of 2023, coming off of 22, where the S&P 500 was off about 18%. And the majority of private equity funds had a positive return for 2022, which the reasons are unique to each particular fund, and that, I would have to go into more detail on an individual basis. There are other reasons for it, though, than just that private equity outperforms. But the point is, when the market is giving you an average return or a less than average return, private equity outperforms by a greater margin. So this is looking at a 20-year time frame from 1996 to 2016 on private equity average as a whole. So this is the Private Equity World Index versus the S&P 500 average return. Now, if we took this out to 2022, the S&P 500 average is going to be closer to 10% because we've had a few really great years in the market, but private equity average return would come up a little bit too. But looking at 96 through 2016, you can see that private equity outperforms, does about 50% better than the S&P 500. But most importantly, it also has a lower standard deviation than the S&P 500. So the S&P 500 is around a 17. Private equity is about 14.5. And there are certain reasons for that, again, depending on the fund. But to break it down in the simplest form possible, a private equity fund or a business within that fund is going to be valued on the true metrics and fundamentals of that business, not by the ebb and flows of the public market. An example would be if you own company X and we're in 2022 and their EBITDA is growing significantly, they're hitting it out of the park on their earnings calls, growth projections look great, they're outperforming every quarter, that stock may have still been down just because of the overall market sentiment and volatility in the market pulling that publicly traded position down, where private companies are valued and the assets are marked by a third-party accounting firm based on the true fundamentals of the business. So this is just looking at a few other time frames, 10-year, 15-year, 20-year, and you see that private equity is the black, public equity is this purple bluish color. Consistently over all time frames, we do see outperformance in private equity. One of the big kind of negatives to private equity is your liquidity. These days, a lot of the funds do have limited liquidity. So they may be an example of a fund accessible for a accredited investor or a qualified purchaser. Maybe that you have to hold it for 1 year. After 1 year, they'll allow 5% of the total assets in the fund to be liquid and redeemed by the investor every quarter on a quarterly basis. But each fund is a little bit different. I wanted to show this just to take it a step further because we do also use some venture capital funds. Venture capital is really just much earlier stage private equity. So you're going to get an even higher return in venture capital than private equity, which we see in blue here. But that comes with its own unique set of risks. There's more susceptibility to volatility in venture capital funds. And for the majority of investors, you're probably not going to want to go into an individual venture capital fund, but a fund of funds where you get access to some of the leading funds may make more sense because you're going to end up with a really well diversified portfolio of venture. And you can do the same thing with private equity, which is what this particular fund, this is one that we like right now. It's from Hamilton Lane. They have been around for over 30 years, one of the larger asset managers, mostly known in the institutional space, but they have a private assets fund. This slide is comparing traditional private equity to this particular private assets fund. So a few major differences. Capital deployment, typically in private equity, at least years ago, if you're an institution, you may commit $1 million to a fund, but they may not call all of that capital into the fund for 2 or 3 or 4 years. In a fund like this, the Hamilton Lane Private Assets Fund, if you want to put $250,000 into this fund, you can do that. They pull the capital in right away and get it to work, and that means that's the no capital calls. Also, the minimums on this particular fund are pretty low at $50,000. There's other funds that are $250,000 or $100,000. And here liquidity is what I was mentioning before. Typical private equity or traditional private equity may have truly no liquidity for 10 to 12 years, some even longer. This particular private equity fund does allow quarterly redemptions at the discretion of the fund manager, right? So it's really one of the negatives is that you have pretty limited liquidity in a fund like this. Now, we do like this fund because of the diversification in private equity. So Hamilton Lane has relationships with hundreds of different general partners or private equity funds. So through those relationships, they're able to access certain investments or certain businesses, certain private equity investments within each particular fund. So they turn down hundreds of investment opportunities every year, but they pick and choose the best of the best to take allocation of from all different general partners and include in this one private equity fund. So the majority of it is direct equity. There's also some secondaries. You will see a portion in credit, and the reason that most private equity funds, at least an evergreen fund like this, that provides consistent liquidity is going to keep a portion in credit anywhere between 10 and 15% to make sure that that liquidity is available to investors of the fund. But lastly, just a good representation, and a lot of the private equity funds that we're using look similar to this. This is just a page from the fact sheet. So right now, this Hamilton Lane Private Assets Fund, you're in 50 different general partners, so 50 different fund managers, 64 different investments. As of the end of November of 2022, at that point, the S&P was off about 17%. This fund year to date was up 14.86, averaging 20.45 since inception. So it really zeroes in on that fact that when the public markets perform poorly, you see a much wider margin of outperformance in the private equity space. There's also some things going on with technology and how that performed and really pulled down the markets, and a lot of the private equity funds maybe not being so centered towards technology and not seeing those markdowns earlier on. So there's some other things at play with why private equity outperformed, which is really a much longer conversation. But This particular fund, this is just showing, here's the 10% that's kept in credit for liquidity, 49% secondary, so that's private equity to private equity, and 41% co-direct equity. So that is Hamilton Lane partnering with a private equity fund and going directly into that investment. So you're not picking up additional fees from Hamilton Lane for Hamilton Lane to then go out, find all different private equity funds, make those investments. You're not doubling up on the fees through this. Mostly in North America, which is good, 15% in Europe, vast majority buyout. So that is when the private equity funds or the investor is buying typically 100% of that business. They're targeting it for a specific purpose with the sense or the plan that they can turn around the company, add value, increase EBITDA, and then of course sell the company, which is usually a process of, in traditional private equity, it can be 7, 8, 9, 10 years, where this fund you have really a perpetual growth in the private equity sector of the market, and really well diversified across different sectors of the market. Communication services, consumer discretionary, 18% healthcare, 22% in industrials, and of course 23% in information technology. So this is just one of many funds that we use. It's certainly not for everyone. It could be for you and your portfolio if you're a accredited investor or a qualified purchaser looking for ways to supplement your equities that are going to, at least historically, generate a better and more consistent return with less volatility, really at the sacrifice of liquidity and, of course, with some higher barriers of entry. So if you'd like to know more about this specific fund or some of the venture capital funds that we're using or one of the many other private equity funds that we're using, certainly I would be happy to walk you through that. My name's Andrew at Jesani Wealth Management. You can reach me at 954-800-8552. And I hope that at the very least, this was somewhat educational about how private equity can play a part in a retail investor's portfolio. Thanks, everyone.